Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Alternative assets have become very popular. As the benefits they bring to investment portfolios are more widely known, and the awareness of alternatives have increased, as has education and the accessibility to alternatives. Well, I have on an industry expert to share his insights into the world of alternatives, the different types, and where he sees the most opportunities in alternatives moving forward. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I'd like to give a very warm welcome to Erick Rawlings. Erick is the managing director and head of research at Fiduciary Trust International. Thank you so much for coming on the show, Erick. Really, it's a complete honor. Thank you for taking the time. Can you please tell us a little bit more about yourself and Fiduciary Trust International?
Yeah, thanks, Ryan. It's great to be on. I appreciate it. So in terms of myself, I'd say mine's a career dedicated to manager research across the asset classes. It started with Cornerstone Partners in Charlottesville, Virginia, and then that followed a 2-year stop in Chicago for the Booth School of Business. And then I moved to Athena Capital Advisors, which is a OCIO and outsourced family office serving ultra high net worth individuals and institutions. Athena was acquired by Fiduciary Trust in 2020. Always a fun time to do a merger during COVID. Uh, and I've led Fiduciary's manager research efforts ever since. So that OCIO outsourced family office is still a core offering for Fiduciary and what was Athena. But Fiduciary Trust broadly is a wealth management firm that's been managing and safekeeping assets for institutions, families, and individuals for more than 90 years.
Fantastic. Manager research, that's one of the primary capabilities of Zephyr and how a lot of our users, one of the main features that our users use. And it's an interesting piece. We talked about how, when you're searching for Sharpe ratio, that's easy. All right. Yep. It's very black and white, but there's so much more to it. And, someday maybe down the road, I'd love to talk just more about manager research and conducting due diligence and what do you really, ask them. I think we'll cover it a little bit later, but I think we could have a whole episode just on doing manager research.
Yeah, that'd be great.
There, as I mentioned at the top, alternatives, they've really grown in popularity for numerous reasons. But how does the current investment landscape for alternatives and how has the demand shifted over the years? David Swinson of Yale Endowment, the late David Swinson, fantastic. He's arguably one of the best investors of our lifetime. He really put on the map that investors should have a larger piece in alternatives. Where has it changed and where do you see it moving forward?
Yeah, no, that's great, Ryan. Yeah, and the whole alternatives, we think about hedge funds, private equity was really a cottage industry, let's say, in the 70s, 80s, early 90s, predominantly used by ultra high net worth individuals.
Mm-hmm.
But then, as you noted, Swenson picked up on that alpha opportunity within alternatives and made it a core component of the Yale endowment, and then a lot of other endowments, and then ultimately pensions and other institutions followed suit. Really late 90s and early 2000s, in particular coming out of that dot-com crash, where people saw that diversification benefit play through with alternatives. Today, there's a bit of another underlying shift in the alternatives investor base going on. Those institutional investors that we talked about, they were the growth engine of the alts allocations over the prior 20, 30 years. But today, they generally find themselves fully allocated and in some instances overly allocated, which we'll touch on in a bit. And so they're not really, they're not getting the distributions back from private equity.
Okay.
Um, so that growth engine isn't there as much. Um, However, we are seeing, as you noted at the top, access to alternatives increasing through the private wealth channel. So down the AUM level, you don't have to be ultra high net worth. You can just be high net worth or mass affluent. And with the use of some of these more accessible structures like interval funds and even just mutual funds has really broadened that base. So that's what I see as the transition right now, where that growth in the institutional side has really sort of plateaued, and now it's going down into the more mass affluent, high net worth channels for that next round of growth for alternatives.
Fantastic. We often talk about the evolution. This space has evolved so much since I started. A lot of it's technology, but this is one space where it's really evolved too, is the investment vehicles and products that investors and financial advisors can have access to. And like you just mentioned, it makes it more accessible to the retail investor.
Mhm.
Um, you talked about private equity. It's probably the alternative that captures maybe most of the headlines, but there's a lot of different alternatives that investors can choose from. I think when I was in the industry managing portfolios, it was always REITs. REITs were
Yeah.
kind of always a staple to portfolios. You know, then there's, like you said, private equity, but maybe the oldest type of alternative is commodities. How do alternatives differ? As a financial advisor, how do I determine what type should I offer to my clients when there's really quite a few, more than what we think?
Yeah, that's right. And right. So we use the term alternatives, but to your point, Ryan, each one is really distinct in terms of why you would do it. So for us, so let's start with hedge funds. So hedge funds for us is about absolute return and generating that return with low beta and low correlation to your traditional asset classes. So we think of it more as like a fixed income complement.
Okay.
Um, then we can talk about like private equity. Private equity in a broad sense, so that's your leverage buyouts, your venture capital, your seed stage investing and distressed investing, sort of the full life cycle of a company. There we're looking for above market returns, so sort of equity plus
Okay.
returns out of that allocation. And you're doing that through the unique attributes of that asset class, getting into a company before they IPO. There's a control premium for like a leverage buyout. And then distressed is sort of taking ownership and finding value in a stressed situation. There is some correlation benefit to a portfolio there, but the predominant reason for that private equity allocation is sort of equity plus returns.
Okay.
And then if we move the commodities for us, we kind of commodities, real assets, we look at those as a hedge against unexpected elevated levels of inflation. So for 2009 through 2020, 2021, not a lot going on in that real asset bucket. And then suddenly in 2022, 2023, inflation came roaring back, and that's where that unique allocation within a portfolio benefited and played through.
I love it. Perfect segue to, I really want to talk about investment portfolios and portfolio construction. And you just talked about it. If you start, like, let's say with just a basic 60-40 portfolio, you realize that it's not really working right now. You need some alternatives. I'm really glad you brought up like hedge funds. You think of kind of the fixed income sleeve. You might reduce that 40% and put it to hedge funds and private equity on the equity side. Is there any other thoughts on that portfolio construction? How should financial advisors look at that allocation? Where do you take, what allocation do you reduce for REITs and so on? How should they think about that?
Yeah, so it's definitely you're when we look at hedge funds, it's really looking at what can I get from cash, what can I get from duration, sort of your traditional fixed income,
Yep.
and what do I think I can get for that hedge fund portfolio? And the hedge fund portfolio is typically sort of a cash plus sort of allocation, so cash plus 300 basis points. And then it's leveraging and looking at that on a relative value basis. So yields change throughout time. So when we were looking at the 10-year yield sub 1%, certainly it could have gone lower, but the skew from less than 1% is sort of in one direction. And so at that point, it's like, well, hedge funds look much more interesting relative to duration.
Yep.
Fast forward through the Fed's tightening cycle, and now cash is looking like a pretty good bankable bet relative to duration and hedge funds.
Yep.
And this isn't to say that it's like the all or nothing. Like we're all in cash and we're all in fixed and then we're all in hedge funds. We're not that crazy because we're not that good at timing. It's more of leaning in onto that relative value as the market sort of presents these opportunities to you.
Fantastic. That's a great explanation, because it's always a question is, where do I take what do I take from to put into alternatives, especially like what alternative? Keeping on with the investment portfolio piece, what benefits do alternatives bring to investment portfolios? I think we all know, but I think it's a good thing to bring up again.
Yeah, for us, it's the diversification benefit to create a portfolio that's robust to reasonable economic scenarios.
Mm-hmm.
Um, so if you can extract the same or better annualized expected return, but do so with less volatility, that means you're more likely to A, hit that return target, which is a benefit, and then B, you're particularly depending on how you structure the portfolio, you can limit and curtail that left side of the distribution, so you spend more time on the positive side of the ledger.
Fantastic. I often doing some studies and research, correlations have increased, especially during times of crisis. We saw that in, post COVID in 2022, where correlations increased, nothing worked, bonds had their worst drawdown in years. So where do you go? And
Yeah.
it's, adding alternatives, which helps, increase that correlation and or reduce the correlation, increase diversification for portfolios, and helps you, create that all weather portfolio, which is fantastic. And that's what's important, in Zephyr, we do studies with asset allocation, and it should move that efficient frontier to the northwest corner when you add alternatives, and that's typically what happens and what you want to see. What alternatives do you find most attractive moving forward? We talked about a lot. We mentioned there's a lot of alternatives out there. What do you find? Where do you find most attractive moving forward?
Yeah, so for us, yeah, as we talked about at the start, a lot of the institutional investors find themselves pretty full up on private equity. Additionally, in this environment, there's been less realizations, so
Okay.
fewer distributions coming back to those that have allocated to those funds. And so the opportunity set for secondaries funds, we think has increased, and looking more attractive, and even more so within the venture space, because a lot of institutional investors got pretty heavy in the venture allocation throughout the post GFC period. And so this is the secondaries strategy is to approach these institutional investors that would like to relieve themselves of these long tail exposures, and you buy them at a discount, and then you see those realizations then start coming back. So it tends to be secondaries tend to have a little bit better of an IRR. So you're putting the money out and then it's coming back quicker relative to a traditional private equity allocation. But your multiple tends to be a little bit lower versus a traditional private equity fund, just because where you tend to be buying into these companies and portfolios. But because the discount is looking a bit more attractive these days, secondaries is definitely an area of interest for us. Similarly, real estate lending is an area that we've been looking into. A lot of refinancing of real estate loans coming up. Most of those loans were done at interest rates that just aren't available anymore. So, with proper structuring, good credit underwriting, you can get a pretty good yield through the debt. Um, and then lastly, I mean, we still like hedge funds, particularly relative to fixed income. It's still a good balance between the two. Obviously, you can get a good yield out the curve, which you haven't been able to do for their incomes back in fixed income. But there's still a lot of volatility as the Fed's starting to move and coming off the hiking cycle. So we think that more absolute return, lower volatility that hedge funds can provide is a nice complement to the fixed income allocation.
I'm glad you brought up REITs. For the long, especially after COVID, everyone was running away from REITs. It's important there's different types of REITs. Can you maybe add a little bit more context around REITs? Especially with maybe interest rates falling, maybe
Yeah.
it makes it a little bit more attractive.
Yeah, I think we're definitely seeing an easing in the lending within real estate and REITs, and I think the other part is just the just transformation of that REIT sector over the past 20 years. The office has declined materially, and now the biggest REITs out there are the tower companies and data centers. I mean, it's definitely reflects the evolution of our own economy. But now, when we talk about REITs, it's a sort of a very different dynamic. Now we're talking about uh, towers and geospatial monopolies as opposed to what a building's going to go for in Midtown Manhattan.
You're exactly correct. It has evolved so much to type, cloud computing and data centers and all that stuff versus, you know, commercial space and stuff like that. So
Yeah,
you talked about interval funds. That's an evolution over the past couple of years, made alternatives more accessible. I always get, yes, we want to include alternatives, but how? Where
yeah,
do financial advisors start to gain exposure to alternatives? In what investment vehicles should maybe they start to look for?
yeah. So we think for hedge funds, we think there's some good managers that are available just in mutual fund format.
Okay.
So that's it. I mean, that's daily liquid, easy, ticker 1099 tax treatment. So that's an easy one. Um, for private real estate and private equity, private credit, you're right. We are seeing the usage of interval funds as a means of providing a greater degree of access sort of down the spectrum of
Mhm.
of um, of net worth, and that's great. I think it does require a bit of caveat emptor in terms of the structure of those, which we can get into in a little bit. But it is a great tool. It gives you access to the asset class. We just have to be mindful of some of the other nuances that interval funds bring in. Um, and then the last real way to go about it is limited partnerships. So that's sort of the very classic old school way of going into it. It's private, it's illiquid. Every fund and fund documents are different. You really have to read the PPM and the sub doc, and it just it becomes a study and a legal study versus the sort of sanctions and structures of certainly mutual funds and UCITS as well. I would put into that for anybody in Europe or elsewhere. Interval funds have a little bit more nuances to them, where you need to start paying attention to the documents and structure. But limited partnerships for sure. I mean, that's we sort of joke about like mutual funds. It's like dating, hedge funds, and interval funds. It's like you're serious, like an engagement,
Yeah.
and then limited partnerships, private equity. That's like marriage. And so your intensity of due diligence and understanding the docs and structures kind of have to reflect those that gradation of intensity.
And so with limited partnerships, you really want to know what you're getting yourself into.
That's right.
It's a
That's right.
partnership, right?
That's
And
it's a partnership. Yeah,
yeah.
that's right. Yeah.
um yeah, it's in when I was, in the industry 20 years ago managing, it was a lot of REITs and limited partnerships. And granted, the home office really filtered them down. So they did, like you, they did a lot of the due diligence and research. So it made it easier for us. But you brought it up. And I think this is really important is doing the due diligence, doing the manager research. What do you ask alternative managers, or what, we don't have a whole session. We could talk a whole session on this, but what are some of the things a financial advisor should look for or ask when
Yeah.
we're trying to search for between limited partnerships or interval funds or hedge funds? Are there kind of some key themes that you look for?
Yeah. So the to simplify it, the two things to really focus on are the process and the structure. So the process is really it's about the manager. What do they do? And what you're really trying to do is understand um, like what are you going to own if you invest with this manager? What are you going to own? Are you going to, let's say you close your eyes and look at a statement in 6 months? Are you going to be surprised by what you see on that statement?
Mhm.
Um, Really having very clear ex ante expectations of the manager, what they do, and what outcomes of the strategy are reasonable in a variety of scenarios. Um, on the structure part, um, this is again getting back to that the limited partnership, understanding, simplistically like which one does the manager focus on? Is it the limited or is it the partnership?
Okay.
Um, and really understanding what it is that you're signing up for. Um, but this is true in the interval funds as well, because each one's structured a little bit differently. And while it's great that these products are now available, and they do um, get rid of a lot of the issues that the limited partnerships did, like the long lockup, the drawdowns, the K1s. Um,
Mhm.
so that's great, but then they do have their own nuances that people need to pay attention to. So like an interval fund, you don't really get control of your vintage year diversification like you would with a limited partnership where you allocate
Mhm.
on an ongoing and regular annual basis. With an interval fund, your vintage year diversification can be dictated by the inflows or outflows into the fund. So if a ton of flows go into the fund, they're going to deploy them. And that's going to be your biggest vintage year just because of the flows. And so
Mhm.
those are the aspects that need to be paid attention to, and investors need to be mindful of when using interval funds.
It's interesting. There's been a lot of talk of interval funds, and there a lot of people. It's a great way to gain alternative, but it's not
They are.
always,
It's
bells
like
and
squeezing the
whistles.
balloon. You solve something, something else kind of.
Yes,
There's something that pops up somewhere else. Yeah.
it's not like what there's no free lunch, right? It's not going to
Yes.
be perfect. So you
Yes.
have to be mindful of that. So I'm glad you brought that up, where there's other things to take in consideration. But I love how you simplified it in processes, and structure. It's very easy to think. And we often talk, investors want transparency. They
Yeah.
want more control, personalization in what they invest in, more so than ever. So it was a really good point how you brought up. It's like in a quarter you can get that statement. Are you going to be surprised
Yeah.
on what you're holding? Or like going to your client, and all of a sudden there's something in there that your client doesn't want to own.
Right. I mean, it'd be no different than if you invested in a whatever a growth manager, and their 13F comes out and suddenly they have Nvidia, ASML, and ExxonMobil.
Yeah.
One of those doesn't,
Yeah.
that would warrant a phone call to the manager about that third position of like, walk me through how this one fits into a growth mandate. Maybe there's a good reason, benefit of the doubt, but you know,
You're
let's talk
exactly
about that
right.
one. Yeah,
That's very important. It's just and making sure whatever mandate the manager has, they can stay consistent
that's right.
throughout many different regimes, whether interest rates are rising, interest rates are falling, value's been out of favor for how many years. All of a sudden, are they fear of missing out and they're loading up
Yeah,
on growth stocks and Nvidia, they capture it? Or it's important that you find out what your manager, what their mandates are, and are they consistent.
that's
And
right. That's right. And a track record is helpful and informative. But one, like you can't buy a track record. If you could, our job would be really easy. Um, it's really on the process. So the track record's a byproduct of a process. And so it's really understanding, was that track record generated because it was a good process and a good outcome? Or was it bad process and good outcome? Sort of, right place, right time, and more of a luck factor than a skill factor.
Perfect. That's a fantastic way of ending that topic there. Let's talk about, we talked about David Swenson and, the big allocation in the Yale endowment. Do you think, investors have enough exposure to alternatives? And in your mind, and I know this, you get this question, it's like, well, Ryan, every person's different. You can't really answer this question, but in your mind, what percentage of investment portfolios should be allocated to alternatives?
It is a personal question. I think it depends on willingness and ability and the benefit to each client. Many of our clients have upwards of 30% in alternatives.
Well, okay.
A lot of that dominated by hedge funds and private equity. Um, but again, like alts, they're not broadly speaking, alternatives, like they're not a panacea. Like they're not like this whatever mythical thing that will solve all your portfolio and the world's troubles. They're tools, right? And they're tools that can help an advisor solve for a client's particular needs or circumstances. Um, Again, like hedge funds, when you're sitting in a 60/40 and you really don't like losing over 10% in your fixed income book, and you don't like the positive correlation between fixed income and equities, well, hedge funds done in an absolute construct can be a benefit into the portfolio. If somebody has a long time horizon, and is willing to take on the illiquidity, private equity can be a nice augment to sort of change that level of potential compounding. And then real estate can be, a nice diversifier in terms of yield. Like you're getting some yield out of cash, some out of fixed income, but there you can get some nice yields, particularly within like real estate debt. That's largely orthogonal to what's going on with the Fed. Not exclusively, but in some ways.
That's fantastic, Eric. That was a great way of saying, like, alternatives. It's a tool. It is not the castle in the sky or
That's right.
pie in the sky. It's not gonna cure all issues. I love the way you put that, and think that's a great way of ending it, because it's a tool that helps increase their diversification, that works as a whole, and it just isn't your one solution is going to cure all issues.
That's right. That's right.
Eric, so I always like to kind of finish the conversation. It's been fantastic. I love it. Love talking about alternatives. Something fun. And not saying alternatives aren't fun, but maybe something a little bit different. It could be industry seeing something in the markets that you just kind of shake your head at, like what are we could go back to the crash that happened a couple of weeks ago, and now it's
Yeah.
way behind us. Or just something that's not related to markets or anything interesting that you've seen recently.
Yeah. Yeah, so we spent a bit of time this summer understanding the U.S. electrical grid, and I know you said something fun, but it is it is interesting because we were going back and what we were trying to understand is one, how do we end up with the grid that we have, and then as we've been looking at all of these projections for increased electricity demand, whether it's data centers, AI,
Yeah.
EVs, Internet of Everything, we wanted to see one, what's the sort of current state of affairs? And then are there any particular company or sectors that seem favorably advantaged for that expected growth in electricity demand? I won't go through all of the conclusions, but what we did come through is that expected growth in electricity is really it's inextricably linked from another theme of ours, which is that there will be more data tomorrow than today.
Yeah.
And when you think about really just the world of moving electrons around, it does get you into some interesting sectors and businesses to study, and a lot of those are in the REIT sector as well. But that's where we've been having fun this summer.
I'm really glad you brought that. It goes back to commodities. A few weeks ago, I had the CEO on of ETF shop, and they invest in electricity. They have an electricity ETF. And I thought it was really interesting. He brought up a very good point where electricity is the most widely consumed commodity,
Yeah,
yet it is not in the big commodity indexes like Bloomberg commodity and all these. And it's like, you would think it is. And why don't more people, invest in electricity, since, like you said, there's gonna be a bigger draw on electricity moving forward.
yeah,
So
that's right. Yeah,
it
it's an
is an
interesting.
intro, and there's
Yeah,
all different ways to gain exposure to it too, right? Through different companies, and but it is fascinating. I'm glad you brought that up, and I think that's fun.
that's great.
Awesome, Eric. Well, thank you so much, Eric, for coming on the show. Like I said, it's an honor to have you on. It was really fun. Learned a lot, as I expected. Where can our audience get more information about Fiduciary Trust International?
Yeah, you can find us at fiduciarytrust.com.
Perfect. And leading up to this, a lot of great insights and content you guys share. So for readers, really good stuff that you guys have. So good job. Thank you so much for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel, iHeartRadio, and Spotify. Thank you very much and have a great rest of your week.